Wow, it seems like everything today has a streaming service. Welcome back to the channel, guys. My name is Leo, and in this video here, we're doing a stock analysis today on Walmart. Now, Walmart just recently announced this Walmart Plus. They're teaming up with like Disney and Paramount and all these other lovely companies. You get apparently fuel discounts if you get this membership, $12.95 a month, and 6 months of Spotify Premium. Interesting. Everything's getting a premium service or something like that. But I want to take a look at Walmart and seeing what's going on. I don't think I've ever analyzed this business. So we're loading this up in the stock research tool, going through my process here by the numbers. Let's see what Walmart's all about. Scanning through our company metrics category right here, folks. We're going to look at the 5-year averages compared to the trailing 12 months in order to see any discrepancies and differences between what this business has been doing. So with Walmart, nothing's really sticking out to me. They've been pretty consistent with our PE ratio sitting at 29 over the 5-year average, currently sitting at 28. EPS pretty much around that 4 point something mark, 6.7 and 4.09. ROE has been pretty consistent, and same with the profit margin, as well as our revenue has been sitting at $576 billion. Okay, net income $13 billion. Free cash flow currently is $3.13 billion, and our average free cash flow is $17.4 billion, and we pay out a 1.68% dividend yield. That works out to be $6.2 billion paid out to shareholders, and that's no problem for us here at Walmart because our average free cash flow, as I said, is $17.4 billion. Okay. Cool. So they've been very consistent in the numbers over the last 5 years. Their free cash flow on average can cover their dividends, pretty decent, as well as a consistent return on invested capital above 10%. That's looking pretty good. A high Almond Z-score sitting at 4.14, where we want to see this over 3, and we have that, no problem, as well as our Piotrowski score sitting at 7. We want to see this number between 7 and 9, folks, and we have that. So for me, off the get-go, Walmart is a fairly consistent company. Now, moving over to our financial evaluations category, where we look at the company's cash flow statements, income statements, and balance sheets, we are grading this company a 5 out of 10. Not a great score, I gotta say, folks. It's not a healthy score. So let's look at what the company's doing right and what they are doing wrong. So what they are doing right is that they have amazing EPS growth over the last 5 years. Phenomenal. If you've been holding on to this stock, that's great to see, as well as we've been buying back shares, so decreasing dilution, which is amazing. Even though it's been a percentage, they're still buying back shares, which is phenomenal. Our net income's going up, our return on invested capital is over 10%, as well as our revenue has been increasing over the last 5 years. Phenomenal. Where we are losing points though, folks, is in our 5-year PE average ratio, sitting at 29.13. We want to see companies that have a PE ratio beneath 22.5. If they can justify the growth at this 29.13 PE ratio, it might be something to overlook. However, they're earning no points from me in this category, as well as our current ratio is currently sitting at 0.86, where we want to see this number above 1.5. That would indicate to us that they have enough assets on hand to cover their liabilities, and sitting below 1, that is not healthy, folks. That means in case of a nasty pickle, if they run themselves into some sort of dire scenario, they won't be able to cover their liabilities with the assets that they have. Return on equity, it's sitting at 14.98. We want to see this over 15%. Honestly, it's not the worst thing. It's pretty much there, so I'm not going to even ignore. It's 2.2%. I'm not even worrying about that. However, one red check mark, or one red X that we're getting here, is our debt to equity. Our debt to equity is sitting at 62%, folks, where we want to see this number beneath 50%. That would indicate to us that Walmart is growing the business through equity and not by taking on debt, in terms of financial leverage. So no points awarded there, as well as our free cash flow has been decreasing over the last 5 years. I'm going to go to our cash flow statement and take a look and see what the story is there. Filtering this out through an annual basis, and I want to see what's going on. And the story is this, folks. Year over year, it's been jumping up a little bit. 2017 having the highest possibly seen in the last 10 years. 18, and slowly it's been going down. 2021 was a great year, and now 2022 ultimately is, obviously 2022 is not completed just yet, but we're a far cry from where we once were. 11 billion from 25 billion. Wow. So it's been up and down over the last several years. Anyways, that being said, what are my thoughts so far on Walmart? I like how consistent they were in the last 5 years. However, we are not earning a lot of points here on our financial evaluations. The one red flag that's coming out to me, obviously our free cash flow and debt to equity. However, there's some things here that I can overlook. Like our return on equity, it's pretty much close enough to that 15% mark. I can overlook that, and that's not a big deal. As well as our current ratio, that is a red flag for me, folks, considering how we are pretty much approaching a recession. So we want to make sure we have enough assets on hand to cover those liabilities. Them being beneath, not even, I would give it a somewhat of a pass if it was just slightly above 1, but being at 0.86, that's not healthy. We want to have at least some coverage of our liabilities. Anyways, that being said, we're going to do a price analysis of Walmart, and what that means is we're going to price out this company, or doing a 10-year analysis using the numbers that they've provided us to price out what we should be paying for this company today. I'm going to fill out these lovely boxes, and we'll talk about it in just a quick second, so stand by. And folks, before we jump into this last section of the video, if you're enjoying the video so far, hit that like button, hit that subscribe button. This software that I have in front of me that allows me to screen these companies incredibly quick will be available to you, my viewers and subscribers. So jumping in to the price analysis section of my software here, taking a look at what we got. So if you know me, and if you're new to the channel, I like to try to stay as conservative as possible. I'm going to discount our revenue growth over the next 10 years to 1, 2, and 3%, just based off the market cap of this company. However, them introducing this Walmart Plus might introduce a whole new revenue stream of people that are flocking towards this business. Walmart is doing the best that they can to try to compete against the likes of Amazon, and getting into the digital platform and potentially making their own content might open up some new revenue streams. However, I can only analyze this company based off the numerics that we have. So what I'm going to do is I'm going to put myself in a conservative standpoint and hope that they end up beating my numbers. So that's why I did 1, 2, and 3. And this is the margin of safety that I'm giving myself. And I've expressed that throughout all my numerics here. Same with my profit margin, my cash flow, free cash flow margin. Same with our price to free cash flow, doing 14, 16, and 18, as well as our PE ratio, 14, 16, and 18, to stay below this 28.24 number and staying below 22.5. And we're going to put our desired return at 13%, lucky number 13, to see what that comes out to be. So the software is going to run through all these numbers and calculate what we should be paying for Walmart today. And take a look at this, folks. So currently, Walmart is slightly overvalued, sitting at $132.57. Average calculation comes out to $70.96. Did we ever get that low? We didn't. When was the last time we were that low? Quite a long time ago, folks. This is probably 2016. Ultimately, if people start flocking towards this Walmart Plus memberships, this could be changed a lot. However, I don't see that being affected in the next 2 to 3 years. This may be a 5+ year thing down the line. As soon as you launch any kind of Plus membership or any kind of new revenue stream, it doesn't just take off right away, right? So this is just based off Walmart as it exists today. So what does that mean for me? I think once it comes down below the $70 range, this is something to take a look into. But those are my opinions, folks. That's my opinion on Walmart. I may be too conservative on this, and comment down below if you think I am. But this is where I would stand with a business like this, considering that we are ranking this 5 out of 10 on a lot of these categories. If I could see a little bit more green across the board, especially in our current ratio and our debt to equity, and ultimately our free cash flow, it would probably change my opinion. But I'm avoiding this for now until we get into somewhat of this numerical range. Write down in the comment section below, folks, a company you want to see evaluated, and I'll get around to it. Anyways, that's the videos. Write down your thoughts. I will see you in the next one. Thank you so much for watching.